Hey guys, welcome back to another Facebook Live with Nomad Financial. I'm Jonathan Goss, the founder and CEO of Nomad Financial. I have a guest today, Brian Minkel, who's from our team to talk. He's one of the managing directors of our accounting team to chat with us. So Brian, awesome having you here.
Happy to be here.
Yeah, we're pretty excited. We're going to talk a little bit more about accounting. So if you are not prepared on this Wednesday afternoon to get a little bit nerdy with us, you may want to go over to a more easier feed to process. But for now, we'll chat accounting. Brian, why don't you introduce yourself to the audience to give them an idea of who you are?
Great. How's it going, everyone? I'm Brian Minkel, Managing Director here at Nomad Financial. As previously coming on to Nomad, I spent a lot of my time in public accounting, about 6.5 years working on both the audit and tax side for a wide range of industries. I never really focused on one particular industry, and it transcended really well here because we work on so many different types of clients, whether it be a SaaS company, a retail company, and yeah.
Awesome. So pumped to be here. I'm going to try to make sure I keep an eye on the audience and the questions that pop up. We'll see if we can get this to work this time. And in the meantime, Brian, let's start at the beginning. Let's go to the beginning of a founder's journey. And they're picking a software to use for accounting. They have many options, right? You have QuickBooks, you have Xero, which are two pretty well-known, robust options. They get inundated with advertising from Bench and QuickBooks and Xero, and they get inundated with advertising from Bench and Indinero, which would appear to be some low-cost options. What does a founder need to know when they're picking their software?
Yeah, I think there's a couple big factors that you want to keep in mind when you're picking your right software. One would be scalability. Does this software allow for you to grow? Will it be capable to sustain with the volume increase that you have? As well as the basis that you would like to be reporting on and where you would see yourself reporting in the future. It might be a cash basis need right now, but perhaps in the very recent future you will need to switch to accrual or start thinking towards that option. And those are some of the bigger factors that really do come into play when you're deciding which platform to use.
Awesome. So let's dive in a little bit because you're giving these reference points to people, like if you need to use accrual or cash basis. Let's start with their decision-making process, right? You're thinking, okay, my plan is I'm going to build a business that I want to go out and raise capital for from institutional investors. What do those investors care about, and what do they need to know if they're picking a certain platform?
Right. I think one of the biggest things you want to think about is consistency and comparability. Will your financials be comparable to your competitors, and can you analyze them on the same basis? And a lot of that, speaks to, the common theme that, a lot of investors, board members and whatnot are looking for that accrual basis, the GAAP financials to be a part of your bookkeeping process.
So if you're going to go raise from these guys, they expect you to be, guys and girls, they expect you to be on an accrual basis. What are your options then? So what can and can't you do to be very straightforward on that?
Yeah, in terms of options, cash basis means, really cash out the door, cash in the door, as opposed to accrual basis, and that focuses more on occurrence. When did the actual transaction occur as opposed to the cash event that took place either before or after?
So an easy example is you're running a digital media site. You have some advertising run in the month of July that just finished. In that month, the advertising ran was $100,000 of advertising. You're not going to get paid for it until August.
Right.
On a cash basis, it looks like all of your money comes in August when the cash comes in.
Right.
But on a P&L basis, on an accrual basis, it'll show that your revenue actually came in July. It's just that you have an accrual on your balance sheet for the cash not coming in.
Exactly.
Right. So the actual P&L is a representation of how the business is really performing. Particularly in that example, say you have $100,000 of revenue and $50,000 of direct costs against it. That'll all show up in the month in which that work was done, as opposed to, everything just on in cash inflow outflow.
Right.
Right. It gives you insight into the performance of the business. So hopefully that helps the audience a little bit in understanding this. But what I really want to get to is, okay, you've chosen a software, right, and you've chosen wrong. Mm-hmm. So I think to go back to our options, you have Bench and Indinero, which are typically cash-based accounting, very affordable solutions. Mm-hmm. If you're a two-person consulting shop, they could be a perfect solution for you. Super low cost. You actually only care about cash in, cash out. You're able to manage your accounts receivable on your own. Right. It's pretty easy, and your taxes are relatively simple. So from a cost basis, use the cheap solutions, right? Use those guys who can do it very cheaply. But if on an accrual basis, based on what it seems like you're saying, those feel wrong to me.
Yeah, you could very well be backing yourself into a corner, which could be a lot more work to pull yourself out of than if you were to initially choose something that could allow you to switch into that accrual basis more easily. So for instance, there's no reason why you can't use cash basis and still have QuickBooks going, as opposed to focusing on maybe a more cost-effective platform at that time, but possibly 6 months or 12 months or even longer from then, you might need to make that switch. And it might be a lot harder to do that when you have the additional volume in place.
So you're saying is the volume being, if you have a lot of transactions in a place, switching is costly if you have to switch platforms.
Right.
So if you're on a platform that really only functions on a cash basis, you then have to leave that platform. So you might be going from Nero to QuickBooks.
Right.
The more volume you have, the more work it's going to take to make that switch. It's harder to do.
Absolutely.
But what's the, does it hurt that much? If you're, talk to us about, for a client, if they come to Nomad and they say, we're going to switch from, Nero to QuickBooks, or investors require accrual-based accounting,
right,
and we know it's not accurate on that basis. Okay, well, is that a problem? Is it hard to do? Is it a lot of work?
Right.
What's the ramifications for making the wrong decision up front?
Right. I think a lot of it depends on some of the factors that you might want as a part of making that switch. And there's a couple things that come into play. Oftentimes there's a desire to have those historicals transferred over to that new platform, and the process of doing so could be labor intensive with a proprietary software that company might own themselves, and there might not be a clean conversion tool which will allow you to capture all of those historicals in an efficient way.
And when you say proprietary, you're talking about the original accounting software that you're trying to move off of.
Right.
So part of their gamesmanship is capturing you and making it harder to leave their software, as opposed to just using a third-party software like a QuickBooks or Xero that's broadly available and most accounting or financial professionals know how to use.
Exactly.
Got it. Okay. So now you're making that conversion. There's there's amount of prior transactions you have to transport over, which could be manually intensive. What are the other concerns?
Yeah. So some of the other concerns are scalability and adaptability with other platforms. Some of these proprietary softwares don't necessarily speak to all the other third-party softwares that other companies leverage. So a couple other platforms that come into mind are whether it's Expensify, Bill.com, Stripe, things like that, and to allow them to speak easy with each other. And QuickBooks has done a pretty good job of making it pretty seamless. Yes, there's some technical things here and there, but overall they make it fairly open source to that extent where they can work together fairly seamlessly.
So if you have a new client come in and you have to put a plan together to actually convert, right? So say we have an audience members who maybe they're accounting professionals, or maybe they run a business, they have enough of an idea of trying to do it themselves, and they're going to make the conversion. What would that plan look like? What should they, if you're kind of outline, here's where I would start and work my way through, what does that look like for you?
Yeah, I think a lot of the plan is, what's that starting spot, right? So it's August right now, but do you want your full set of 2017 to be on one software? So perhaps our approach would be, let's take the ending balance of 12/31/16, that trial balance per se, and transfer it over to the new platform, and that would be a one-time opening balance journal entry. And at that point, then going forward, you would,
meaning, just to give some explanation, meaning if there's $100,000 in cash on the books,
right,
you're literally saying, okay, at the end of the year there's $100,000 of cash on the books, and now at the beginning of this year we're making a single journal entry to represent that.
Right.
Yeah.
Along with the other related balance sheet accounts, P&L accounts, etc.
Got it.
So a lot of that comes into the scope and the approach there of what you really want. Sometimes it might be a situation of, let's just start, halfway through the year. So July 1st, we'll make that switch. I'm not worried about having part of my historicals on one platform and another part on another platform. That's completely okay, but allowing yourself still to work through that opening balance entry and start at that one point, you're putting yourself in a position to then work through, fairly seamlessly for the rest of the year.
Got it. So now you've decided a starting point.
Yeah.
What's next? What's the next thing you're going to review as part of your plan?
Yeah, so I think there's a couple things that come into play. In terms of I guess some of the switches, right? So for instance, if you're on a platform that's more cash basis, you might want to incorporate some of the accrual accounts that should have already existed if you were already on that basis. So for instance, if we were taking the approach of switching as of July 1st from one platform to another, there might be an element of also building up those accounts receivable, accounts payable, accrued expenses, those accounts as well as part of the conversion.
Got it. And the chart of accounts, do you think you're going to use the same chart of accounts that does all the categorizations for the folks out there?
Right.
Or you just use the same one that was used before, or is that part of the review process as well?
I think a lot of it would be, leveraging off of what you've already built. So, there's no need to recreate the wheel. There's absolutely, it's completely fine to work off of what you already have, but it's a part of building that towards the accrual accounting. So, some of the accounts I just mentioned might not have already existed if you were on a cash basis.
Yep.
Whereas looking forward, you would want to build those accounts out, and we commonly have, a typical list of accounts that come into play commonly when you're using that accrual basis. So prepaid expenses, accounts receivable, deferred revenue, those are a lot of the accounts that you would want to start thinking of and building them up. So to allow yourself, once you get into that new platform, you're then working towards using those actual accounts as well.
And so let's use prepaid expenses as an example. You're now creating it didn't exist before. What ends up there? What are the offsetting entries? How does this look for somebody who's going through this process?
So for example, one process might be, let's take the same example. It's August right now, but we want to take the approach of actually converting as of 1/1/17, and that would be taking an assessment of all the other expenses that had come into play throughout that year. So for instance, a common prepaid expense is prepaid insurance, right? So perhaps there was a policy in March that you paid for. On the old system, it would have been expensed right away as insurance expense, but moving to this new platform with this new approach of accrual accounting, you would then take that transaction and actually record it into prepaid at that time and then amortize that expense over the life.
So a good example is your insurance as a company is pretty large, call it $25,000. You've created some rule set of where if the dollar amount's below that, you'll still just expense the dollar amounts above that. You'll then put it in prepaid and accrue it over the course of the year. Okay, so you're going back and you're figuring that in the middle of the year. Mm-hmm. So that's the main journal entry to put it on the books. It's the cleanup every month after that, mm-hmm. and removing it from the the actual original entry that took place.
Right.
So there's a lot of work involved in correcting it versus
mm-hmm.
if you just done it right the first time.
Exactly, and then again with talking about volume, if you're talking about only working through 50 transactions as opposed to 300, there's a lot more work involved with that higher volume.
If somebody comes to you and they're a new client, and they've either been on, call it two clients. One has been on QuickBooks and maybe managing themselves and not doing a perfect job, but mm-hmm. trying to be as much on the accrual basis possible, versus somebody who's using a platform, say like Indeniro or Bench, and they're making the switch over. Mm-hmm. In terms of the amount of time, say it's the same company, they would have managed the same amount. Right. Which one's easier for you? Which is less time intensive in terms of cleanup and correction?
I would say the one that's already on QuickBooks. It just allows for a more seamless transition because it's already structured to allow for that accrual accounting, as opposed to a platform that doesn't really allow for that from the onset. So,
on a factor, just to give the audience an idea of a factor of, is it could be twice as expensive, 4 times expensive? How much more expensive is it when you make that mistake from before?
Right, yeah, I think it also depends on how far back you might want to go and restate some things, but I could say it could easily be double the amount of time.
Yeah, so it's a pretty expensive mistake to make.
Yeah.
Got it. And not to mention, it may impact any taxes you filed or
right.
are in the process of filing.
Right.
Right. So there's the cleanup there. When you're going over people who are coming to you from usually these platforms, what are some of the weaknesses that you really kind of dig in on and you think these are areas of exposure that we need to be concerned about?
I think of the processes, on a monthly basis, and whether it's the accounts receivable process or the accounts payable process, and that might not even have existed in the first place because you're on your cash basis, you're recording as cash comes in, cash comes out. You're not really thinking about what it means to have an actual process in general. What is that revenue recognition process? So I think a lot of it also comes into play of building out that process and sticking to it as a part of what we also deliver as well, and that consistency from month to month with allowing yourself to record invoices as they're received in the proper period that they're invoiced in, so on and so forth. Having that process of working through those different types of transactions is a big thing.
Yeah. So an example of the process, we'll talk about revenue recognition.
Right.
Right. you're coming off an ending or a bench, there's nothing there. Maybe if you were on QuickBooks or Xero before and you're still on the same platform, you might have been trying, it might require a little bit of cleanup. Maybe there's not the backup documentation, which is critical to have. So for every balance sheet account, you should have backup information to document why the math is being done, as opposed to just putting in journal entries. That's, does not leave an audible trail, right? So at some point, if you raise institutional money, you're probably going to get audited. It's usually written in term sheets. If you're not prepared for that, God bless your soul, it's going to be expensive and hard to fix, particularly if you're light on cash because you're going into fundraising and now it's required of you, and then you have so little money to spend, and this is something you have to fix up to get through there. It's the wrong time of year to deal with that mistake.
Absolutely.
Yeah.
Absolutely.
So why don't we talk on a rev rec process? What would be a typical process? Maybe pick a SaaS company as an example.
Yeah, I think, the very onset would be, let's walk through a typical transaction from start to finish. So that would be, from the time the engagement was signed or, the deal was entered into upon the service being rendered and then, the cash collection. Walk me through that process. So for example, one company might say we're billing in advance for the services we then perform, whereas another company might say that we're invoicing at the after the work has been completed. So it's understanding, the timing of different events, which will then trigger, the need for, building out that process for those, events.
Got it. So far we've really been talking process, structure, without any given actual examples, right? Hard examples. Maybe talk about a client or two, and without using names, and giving out, maybe talk about the industry they're in and their size, so people have a reference point of what the process went like, what was like when you converted them from, call it, an engineer to a QuickBooks.
Yeah, so a couple situations come to mind, and I think part of it is at what stage is that company in. So we've been involved with early on conversions, and it might be a company that's still pre-revenue. So that process in and of itself obviously simplifies the conversion a lot. There's less moving parts.
And not to interrupt you, sorry. When we say simplify, we mean cheaper and easier, right? Less time.
Absolutely,
yeah.
100%. So in those situations, it might not be as big of a headache, and we could get through it a lot easier. Whereas, a company that might be already up and running for 3 or 4 years, and they're, definitely post-revenue, maybe even, Series A at that point, which, could be a concern in and of itself. But besides that, that would definitely require a lot more work and a lot more planning in terms of, okay, the engine is already running. We don't want to disrupt the engine. We want to keep the motor going. But how do we then also ensure that everything's converted in a seamless way that allows for you to still run your business?
Awesome. I'm through most of my questions on this, Brian. I don't know if there's anything you think we may have missed or you'd want to add about this process, or little bits of advice you might recommend to entrepreneurs just from an accounting basis of people you work with before, that you say, here's 2 or 3 good tips that I think if I was a founder, I would love to know.
Yeah, I think one of the biggest tips that I would say is you can kind of treat accounting as a language. And understanding that language and respecting that language can go a very long way. And what I mean by that is if you're talking to someone on the same page, you're allowed. It allows for a more seamless conversation. So that goes on multiple levels. Whether you're comparing your company to competitors and how are you performing against them. If you're speaking the same language and you're on the same basis as them, the comparability is a lot easier to analyze. In another token, if you're speaking with investors and they are focused on analyzing financials on an accrual basis, are you already on that basis, and can you seamlessly speak to the ins and outs of what you're already using with your company, the basis that you're already using.
Awesome. Well, I think that's it for this week, guys. I'm going to give you a heads up for next week. We're going to have Peter Massey, one of our CFOs with a phenomenal background, who has a history of taking companies from building stages, less than 10 people, to exit, both M&A and public transactions. Pretty exciting stuff. We're going to be excited to have him on the show to talk more about preparing for an exit and what you can do. So stay tuned. We'll have him next week and look forward to seeing you then. Thanks, Brian.
Take care. Thank you.